All right, thank you, Daniel. And for those, click the interpretation at the bottom if you're English speaking so you can hear if we do get a question in Spanish, the interpretation. That being said, tonight's session is titled Setting Your Financial Foundation, and we're happy to have Ariel Ferreira from the World Changers Agency who will be presenting and answering your questions. We wanted to have this session to increase financial literacy within our community. Ariel will break down the essential steps to build lasting financial stability, whether you're just starting out or looking to strengthen your current financial habits. This session will equip you with the practical tools and smart strategies with your finances. And with that being said, I'm gonna hand it over to Ariel so he can start his presentation. And once again, if you have a question, please place it in the Q&A box and we will get to it once Ariel is finished presenting. Thank you.
All right. Thank you so much, Dakari. I really appreciate it. And thank you to everyone that's here. You could have been somewhere else, but you chose to be here to be able to secure your financial future. And I'll tell you a little bit about myself. My name is Ariel Ferreira. I got involved in the financial industry a little bit over 9 years ago. And the reason why I got started or got involved is because I'm Dominican, born and raised in Washington Heights. My parents are immigrants. They taught me everything that they could so I could understand how to be a stand-up gentleman and have great work ethic. But they didn't teach me financial education, not because they didn't want to, just because they didn't know. So throughout my professional career and as I was growing up, I made a lot of financial mistakes. And it wasn't until I got married, they say women turn boys into men. So when I got married, I said, hey, I got to learn how to keep my money so I could keep my wife and also build a good quality of life for my family. So I started getting educated. I got educated financially, and then I realized a lot of people from our community don't have this information. So I'm very passionate. I spend my time educating folks on how money works, the rules and the principles of money so they can secure their financial future. So today, as Dakari said, we're going to be jumping right into it. We're going to be going over exactly how to set a financial foundation. And can I get a thumbs up if you can see my screen, Dakari? There we go. Perfect. All right. So we're just going to get started right into it because this is one of the most important things is to be able to set a financial foundation. And why? Because there's a lot of concerns when it comes to money that we're experiencing on an everyday basis. So getting just right into it, there's four areas of concerns. Really, when people start worrying about money or thinking about their future, the first thing is time. And we'll talk a little bit about that. Is time. When do I get started? Should I start saving? Should I start investing? I want to wait for the right time. Well, the more time you have, the more wealth you get to build. The less time you have, the less wealth you get to build. Then the next thing is inflation. When you think about the word inflation, you think about the increase of cost of living. Like, I don't want to date my age, but I remember back in the days, you used to go into the bodega with $1 and you could get a whole bunch of different things and come out with a bag. Now you can't buy anything in the bodega with $1, right? So the increase in cost of living is super important. So how do I make sure that my money is growing and outpacing that? Because some people live in what I call a financial la la land, where they say, hey, I make about $75,000 a year or $100,000 a year in my job. If when I retire, Social Security, my pension, my 401k gives me that, I'm gonna be okay. Well, guess what? $100,000, $50,000, $75,000 is not going to be the same in 10, 15, 20, or 30 years from now. That's why we know a lot of people that should be retired but are still working, not because they love their job, but because they never took into account the increase in cost of living. So we're going to be talking about how to outpace that. Then the next thing is inflation. I mean, losses, right? Everybody wants to invest in the market, but nobody wants to lose money, right? Nobody wants to be able to lose money. They want to be able to make money. So we're going to talk about strategies on how to minimize the impact of losses in the market. And then in this country, they say that there's two things guaranteed: death and taxes, right? How do I minimize the burden of taxes later on in throughout my retirement years? So we're going to talk a little bit about that, but then there's some other concerns. There are some other concerns, folks, when it comes to your finances. The first thing is right now in the United States, there's a $4 trillion retirement savings gap. A lot of people right now are not prepared to retire because they have little to no savings when it comes to retirement. So that's one thing that you have to prepare for and start right now if you haven't started. The reason why that's so important is because a lot of people depend on Social Security for retirement. But right now, the way our country is going, by 2033, Social Security will be insolvent. Pretty much, it's actually not going to be able to pay out 100% of the benefits that they're paying out right now. And if you look at the statistics, 61% of Americans rely on Social Security for at least half of their income. So imagine you being in retirement, not creating another source of income, or not creating wealth, or not having a retirement fund, and you're dependent on Social Security, and then it starts to deplete over time. So it's something to prepare for. The next thing to prepare for as well is, folks, we are pretty much living longer lives. So here, according to an Association of Health, right here are some ages, right? Asian families are living on an average of 84 years. Hispanic families are living an average of 78 years age. White families living to 76, and Black families living to 71. Now, why am I stating this? Because, folks, if you live longer, guess what? That requires more money. You need more money. The longer you live, the more money you need, right? So you want to make sure that you're also not outliving your money. You want to make sure that it's growing. So we're going to talk a little bit about that and get into that and how to solve these things. And then the next thing is, hey, the longer you live, guess what? It's inevitable that you might get sick. So I want you to understand that there are rising healthcare costs. And according to the retirementguide.com, 67% of bankruptcies have to do with medical bills. 67%. Most people are not prepared financially if they ever get caught with a chronic, critical, or terminal illness. So, how do you prepare yourself for that? And then, not only that, on average, couples that retire at the age of 65, they end up paying about $275,000 in healthcare costs and medical bills throughout the remainder of their life. So it's very important to understand that these are some very powerful concerns that you have to be able to prepare and set up your financial foundation. And then the last thing is no legacy planning. Right now, according to the Federal Reserve, there's very few families that report generational transfer, generational wealth transfer. If you look here, 30% of white families report receiving an inheritance. When it comes to Black families, it's 10% of families report receiving an inheritance. And with Hispanic families, 7% report receiving an inheritance. So we're going to be talking about how to have also proper estate planning so you can have a smooth transition for your family to receive, so they can receive your assets and be able to protect them. Now, why does this all matter? You know, a lot of times people say, hey, money's not everything. Money's not everything. Money's not everything. But guess what? It is, because it all affects what matters to you the most, right? If the cost of living is going up, guess what you need? More money. So you need to increase your income. If something happens to you, you want to make sure that you want to protect those you love, your children, your family, your partners. And you want to also be retirement ready. You have to have money for that. And then you want to be able to build a legacy and pass that on with generational wealth. And then most importantly, guess what? You need money to provide a quality of life, right? To your family, to your children. Like a lot of the times, you know, one of the reasons why I work so hard is so I could be able to provide a great quality of life for my children. I have a 20-month-old daughter and I have an 8-year-old son. And right now he's in tennis school throughout the summer. He's in a summer tennis camp. And I'm paying about $7,000 for that to make sure he could have that. And hey, guess what? It's for him so he can have a better upbringing. And that's why this is so important, to be able to set a foundation, because when it comes to money and securing your financial future, it does matter. It is everything to what matters most to you, which are your loved ones and your financial future. So we're going to step into like 6 areas that you actually need to secure, or hold on one second, I'm having some technical difficulties here. There you go. 6 main building blocks for your foundation. And right here, we're going to talk about these 6 areas. We're going to break them down. The first one is cash flow. I've learned 2 things, folks. Everybody knows how much they get paid, down to the cent, down to the dollar. But in most homes, people don't know where the money goes. So it's all about budgeting. So we're going to talk a little bit about that. Then there's debt management. In most homes, 25 to 30% of their income goes towards debt. So imagine if they were able to eliminate that debt, they could reposition it and put it towards wealth building. Then you have to have emergency funds. We'll talk about how to set that up. Proper protection, life insurance, and long-term care, and protecting yourself in case you get sick. And building wealth, what are some money concepts that can help you build wealth? And then how do you preserve that wealth through proper estate planning? So we're going to go in and do a deep dive. And I hope this is going to be very helpful for you. And the first thing is cash flow. So here is number one is create a budget. You have to be able to establish a budget for yourself. And it doesn't, there's many different types of ways to create a budget. And it's not a one size fits all. Some people, do a line item budget. Some people follow a zero-based budgeting formula. Some people do envelopes. Hey, whatever works, works, right? Even banks now are providing budgeting uh, uh, software tools within their applications. But you want to be able to create one and stick to it and stay consistent when it comes to creating that budget and following it. Now, what you want to do is understand what comes into the house. How much income comes into my house? Then once you establish that, the next thing you want to be able to establish is what are your expenses? And I would say that there's three different categories where you could put your expenses in. The first one is our fixed expenses. These are expenses that will never change, like your rent or your mortgage, right? Or your cell phone bill. You're paying $100 a month, or your car insurance, you're paying $200 a month. Those are fixed expenses that you pay on a monthly basis. So you want to write all of those down and line them up and categorize them as those are your necessities, right? Then you have variable expenses, things that are going to change on a monthly basis. You want to categorize that as well. You're looking at food, right? Your food can go up and down. Your light bill could go up and down. Sometimes in the winter, it's low. Right now in the summertime, I know we're experiencing some high light bill, right? Because we have the AC on all the time, right? So that could be like a variable bill. Then you have discretionary expenses. Discretionary expenses is money that you choose to spend, right? You choose to spend. And it's important to understand, identify these because in most cases, something that you may want but don't really necessarily need. And this is where you can identify areas of savings. And this is the next action step. And I'm going to give you an example. What's a discretionary? I'm going to let you in on a little secret, folks. I'm addicted to coffee, right? And before I took control of my finances, I used to spend $5 a day on a caramel macchiato, right? That's $150 just on coffee in a month. Over $1,000 on coffee in a year. So guess what? When I understood that, I started making my coffee at home. I walk around with the thermal, and guess what? Now I save $150 a month, and I get to do what? If you see the second action item, I get to reposition that money. So I reposition it now towards saving, towards building wealth, or to eliminating debt. I'm able to reposition that money and give that money a different purpose. And then the last thing is, a lot of times I've sat down with a lot of folks that say, hey, Ariel, I did the budget. I identified my fixed and variable expenses. I don't even have room for discretionary funds, for discretionary expenses. But I'm trying to do my best. When in that situation, yeah, you need to increase your income. You need to increase your income, and that goes through, hey, getting a further education, getting a certification, asking for a promotion at your job, sitting down with HR and seeing how you can grow within the organization that you work for, or even starting a part-time business to be able to grow your income, right? Because math is math, right? If you are on a certain budget and you are paying all of your expenses, but you can't eliminate any more expenses, then guess what? You need to make more money. So that's a great way of helping you with your budget. So this is very, very important to understand. So I hope this part is clear, and we'll have some questions. If there's some questions, you could throw them in the chat. I am paying attention to it here on the side. But I'm going to jump into the next one. The next thing is, especially when it comes to emergency funds and building a financial future, this is a formula that most wealthy people and successful people and people that are financially stable is pay yourself first. And it's pretty much that before you do anything, before you go out and spend money on coffee, right? Or before you go out into a restaurant, or before you do anything else, go clothes shopping or go on vacation, you take a percentage of your money and you put it aside first. You start saving for yourself first, because at the end of the day, folks, if you don't save money, money won't save you. So you have to be able to save money. And we have a formula, right? If you want to be broke, you don't do it, right? You don't do it. And if you want to live paycheck to paycheck, you save about 10% of your money. So let's say I'm just going to use simple math, right? So if you're making $1,000 a month, then you want to save 10%, that's $100, right? Or if you're making that weekly, you want to save $100 weekly. If you want to live a comfortable life, you save 20%, right? If you're making $1,000 a week, then you're saving $200 a week, right? And if you want to retire early and create wealth, you save 30%. Now, I've sat down with a lot of clients that sometimes tell me, Ariel, I would love to do the 30%. I would love to do the 20%. I would even love to do the 10%. I can't even do it, right? And that's cool. I understand that. That's real for some people. I used to be that person where I couldn't save 10%. So I understand it and I get it. But what I've learned is that you have to start saving something. I don't care if it's $5, $20, or $25, or even $1. And the reason why I say is because savings is more of a habit and a discipline that you build over time. You see, I always tell people you can't save $500 a month if you've never built the habit of saving $100 a month. You can't save $100 a month if you never built the habit of saving $25 a month. So it's just start saving with what is more comfortable for you and real for you to be able to do. And I will tell you, you'll be surprised even at how small contributions over time can create wealth and create a cash reserve for you later on in the future. So even starting small. So I'll give you a piece of advice because this is another mistake that we do. Oh man, I wish I could save the way my cousin saves. I wish I could save the way so and so saves. Their journey is different than your journey. You just need to start on your journey and start saving, if that makes sense. Right? So you got to be able to do that. Start with a number that is real for you and that you can stick to, non-negotiable. Hey, if it's $25, if it's $200, if it's $1,000, wherever it's realistic to you to start saving so you can secure your future. So that's where it starts. The next thing is debt elimination. So here, there's many different types of strategies to eliminate, and there's two main ones. There's snowball and there's avalanche strategy. And you can Google these, or I'll give you a chance to fill out a survey later on and we could possibly help you. But the first thing you want to do is be able to itemize all of your outstanding debt and list them in highest to lowest in interest rate, whichever one has the highest interest rate to the lowest interest rate, right? And you want to list the monthly payments and the monthly minimum payments for each one. So if you're in a position that you can pay a little bit more, the way this works is that you will pay the one with the highest interest, you will pay that one a little bit more. So let's say all of your cards, you have 10 cards, the minimum payment for each one is $25, but you could put another $50 towards your debt. Well, that $50, instead of spreading it out through all the cards, you're going to take that $50 and pay the first card with the highest interest rate. So you'll be paying $75 and a minimum to the rest. And then what you do from there is that once you're done with that card, you take that $75 and add it to the next card. So that second card that you were paying $50 to, now you're paying $125 to. And you keep doing that, creating kind of like a snowball effect until you eliminate all your cards. You'll be surprised, folks. I've sat down with people that were paying their debt. They were paying their debt every month on time, paying even a little bit more. But it was going to take them about 20 years to get rid of their debt. But after we implemented this strategy, for some people, they were going to be debt free in 3 years, for some in 4, for some in 5, for some even 2. Why? Because it's not just about paying your debt, it's about how you're paying your debt. So you have to be strategic when it comes to eliminating debt. The next thing is some people consider transferring their debt to another credit card. But you got to be careful because those also have transfer fees, and sometimes you may end up getting more added to your debt based off of the transfer fee. The next thing is if you're going to consolidate it to a loan, you want to be careful because you want to make sure that that loan has a low interest rate. So when it comes to consolidating, make sure that you have the lowest interest rate as possible. And then the next thing, folks, is quit charging the card, right? I go by a model that if you can't pay for it from your bank account, you shouldn't use your credit card. Right? But quit charging your card to be able to help you eliminate your credit cards, right? And the strategy that I went over right now, where you pay the first one the most and the next one's the other one's the minimum payment, that strategy, I'm going to give you a disclaimer, only works if you're not using the cards. If you start to implement that strategy and you're using the cards, guess what, folks? You're going to stay in debt. It's not going to work. So you want to make sure that you are not using your cards, right? Now, moving on to the next thing is start thinking about proper protection. And I want to take a moment because in our communities, we usually don't talk about this, right? We really don't talk much about this topic. So I want you to take a moment and think about this. What if you passed away prematurely? What if your partner passes away? If you're married or have a partner or domestic partner, what if your partner passes away prematurely? And what if you get diagnosed with a chronic, critical, or terminal illness? Would your partner and or your children be left for better or for worse financially? And if it's for worse financially, then this is the conversation we need to be having. If you are set with proper protection, great. But you have to have life insurance, either a term or permanent. There's two main categories, temporary and permanent life insurance. Now, there's a lot of conversations on social media. Which one's best? Oh, well, term is better, permanent is better, cash value is better. All life insurances are great. It depends on what strategy you're going to use it for. As you can see on the right hand side, a lot of times my clients ask me that they want to get life insurance. I ask them why they want it. It's for different reasons because usually you could use it for different situations. But you could use it to pay final expenses, kind of simple life insurance, $15,000, $20,000 to cover your burial costs or final ceremony, things of that nature. Then you have living benefits. Some people get it for that. Ever since around 2016, companies have updated their policies, and now if you ever get a chronic, critical, or terminal illness, you could actually access the death benefit while you're still alive. I had a young lady, one of my clients, she was like 36 years old, got cancer. She had $1 million policy, and she was able to withdraw from her $1 million policy, pay off her mortgage, cover her daily expenses, and she was even able to pay for treatment that her health insurance wouldn't cover. So think about that. It's so important because a lot of us do two out of three things that we should be doing. The first one is we get life insurance, maybe a final expense to protect our family and cover the cost just in case something happens to us. The second one is we build retirement funds. We contribute to our retirement accounts, or we start saving, we start investing because we don't want to outlive our funds when we're retired. The last thing is that we don't protect ourselves in case we get a chronic, critical, or terminal illness. You just never know, right? And I always say that illnesses never discriminate age. So this is something that could definitely help. You could also use life insurance to replace income for your loved ones, cover a mortgage. So let's say you own a property, you have a 30-year mortgage, you might want to get a 30-year term life insurance to cover the mortgage just in case something happens to you. Your family could pay off the mortgage and stay with the house. I've seen situations where people are the primary breadwinner passes away, doesn't have life insurance, and guess what? The family either has to sell the house or go on foreclosure, right? You could also use life insurance to create supplement retirement income. You could use it to cover college expenses. You could use it to create an inheritance. You could use it to pay estate taxes, to create a source of savings. There's so many different reasons on why you could use life insurance, but most importantly, you want to use it to protect your family, your loved ones, and your financial future. Now, the question is, how much life insurance should I get, Ariel? Well, in the industry, we use the formula called the DIE method. And this is pretty much where you add your debt, you add your income, you add your mortgage, and you add education for children if you want to cover their college, and you minus any insurance that you might have in place. And this will let you know if you have a shortfall or surplus, but it'll also let you know how much insurance you actually need. So I'm going to give you a quick example. Let's say you have $50,000 in debt. Let's say you make $75,000 a year. Well, you multiply in the industry, we multiply that by 10 years because you want to replace enough years for your family, right? So that's $750,000. Let's say you have a mortgage, $400,000, right? And you want to protect your family. And right now, if you have a child and you want to cover college, we're averaging about $125,000 for a child for a 4-year college. So if you have one, that's $125,000. In this example, you would need about $1.325 million in life insurance coverage. Now, here's the point. This is your insurable need. Excuse me. But you don't need to get all of this life insurance if you don't want to. You could get what matters the most to you. You could say, hey, you know what? Forget the income, forget the debt. I just want to cover the mortgage, and my child could go get a scholarship or a grant, or they could get a student loan like I did and figure it out. So I'm just going to get a life insurance for 400,000. But at least understanding this formula, you will know what's you represent to your family and actually how much coverage you need, right? So the other thing that I want to say about this, sometimes people tell me, hey, Ariel, I also have a life insurance at work. I don't need to go out there and get one. Well, that's a misconception. Why? Because you only have, in 95% of the times, that life insurance that you have at work, you only have it while you're working there. And in the few cases that if you leave your job, let's say you get fired, you resign, or you get sick and have to leave, if you leave and they allow you to transfer, in most situations, it's a lot more expensive than if you were to go get it out on your own. Because remember, you got it at a discount because you were an active employee. And I'll tell you the story. My dad passed away about 4 years ago, and he had a he had a life insurance outside of work, but he had one out at work. And he was on a ventilator. He was there for quite some time in the hospital. And the HR department told us, hey, if he would have been alive for another week, he would have lost that life insurance and his health insurance and all those benefits, right? So you got to be mindful of getting one outside of work because you never know. What if you get sick and you can't work anymore? Well, guess what? Now you don't qualify for a life insurance. So it's great to get one outside of work. So the first three things that we went over is to, one, create your budget, create savings, and protect your family, and protect the most valuable asset that you have, which is yourself, and that you represent your family. Now we're going to go into establishing your financial foundation as a launch pad for your dream retirement. So we're going to go over some quick money concepts that can help you understand how to grow your money and the mindset that you should have as you're creating your financial strategy. All right. So the first thing here is the rule of 72. I don't know if you know this, but this rule of 72 was made famous by Albert Einstein. And when they say the rich is getting richer, it's because they're taking advantage of this tool. And this formula is pretty simple. You take the number 72, you divide it by any interest rate that you're receiving, and it lets you know in how long your money is going to double. So let me give you an example here. Let's say that you all have $10,000 and you're investing it one time into 4 different accounts. Let's see how this formula works. So the first one, you're getting 1%. You're 29 years old. Everybody here is 29 years old. You invested $10,000 at 29 years old at a 1%. 72 divided by 1%. In 72 years, you're going to see that money double. You're going to be 101 years old. How excited are you? Most of you probably can't see you, but you're not. Jakari is like, I'm not excited, right? He's probably speaking for all of you, right? So, but think about this. Where do most people put their money? They put it in the bank. And most banks are giving you 0.01%. You probably need to reincarnate like 3 times to see your money double. And most people are not taking advantage of high yield savings accounts that exist today. Where you're getting, like right now, high yield savings accounts are giving like about a 3.5 to a 4% rate of return. If we go to the next column, 4%, 72 divided by 4%, every 18 years your money is doubling, right? So now at 65, you have $40,000. 6%, 72 divided by 6%, every 12 years your money doubles. So now at 65, you have 80. 12%, every 6 years your money doubles. So now at 65, you have $640,000. So this simple concept can show you how to take advantage of interest so you can maximize and accelerate the growth of your wealth. Now, the same way this works for you, this could work against you. Because guess what? You put your money in the bank, they give you 0.01%, and they turn around and they send you a credit card. Most credit cards are right now 29%. If you divide that, 72 divided by 29%, the bank is doubling their money every 2 to 3 years. So when it comes to growing your money, you want to have the highest interest. When you want to borrow money, you want to have the lowest interest because you could double your debt as well quicker if you have a high interest rate. So once you understand this, then it's time to understand the different options for your money. There are 3 different categories, and all financial accounts fall under these different categories. And the first one is fixed accounts. These are accounts that have a fixed rate, kind of like your CDs, your savings account. You have a guarantee, your money's safe, but it's not really outpacing what? Inflation, the increase in cost of living. If we were to look at this right here, this would look kind of like if this was a heart monitor, right? It will look like your money's dying. Why? Because it's not keeping up with, it's losing purchasing power. The next one are variable accounts. These are like your 401ks, investing in the stock market, investing in crypto, investing in IRAs, Roth IRAs, anything that's market related, right? You participate in the market. If the market goes up, you make money. If the market goes down, you lose money. You don't have any protection. And if we were to look at this, it would probably be like a heart attack, right? Because you don't know whether you're making money or losing money, right? And then the next accounts, we call them indexed accounts, they're also known as protected growth. This you could find in fixed index annuities, and you can find them in cash value life insurance and index funds. And pretty much when you invest your money into the market, when the market goes up, so does your money. Now, if the market goes down, you don't have to worry because you have 100% protection from the downside of the market. So you never have to worry about losing money. And better yet, you never have to worry about recuperating money that you never lost. Now, although this sounds great, I want you to understand that a great strategy does involve all three. Now, the question is, what's the right strategy for you? Because everybody has different needs, dreams, and goals, and different budgets. So everybody requires a different type of strategy. I'll give you an example. I had a young lady, she came to my office. She was like 29 years old, 30 years old, and she was max funding her 401k, putting a lot of money into it. So I asked her, why are you doing that? She said, well, I want to retire at the age of 45. So I asked her, so why are you doing that? Because that doesn't make sense. She said, well, that's what everybody at my job tells me to do, all the senior staff. And I said, well, that makes sense for them because they're probably going to retire after the age of 60. But you plan on retiring at the age of 45. So if you're going to withdraw money from there, guess what? You're going to get penalized 10% and you're going to get taxed. So it doesn't make sense. That strategy doesn't make sense. Now, although it's a great strategy for someone else, it wasn't the right strategy for her. So you got to have a financial strategy for you that works for you. And that's why sitting down with a financial professional is great. And also getting educated and learning this so you can start implementing one for yourself is so important, right? Now, the other thing is once you have that, and I talked about, why that a great strategy includes all three. And the reason why is diversification. I like to use this example to show diversification, right? Let's say you were about to go to the 100th floor at the Freedom Tower downtown, and you had two options of elevators. One elevator had 5 ropes, the other elevator had 1 rope. Which would you take from a standpoint of security? Most people, when I speak to them, they say the one that has 5 ropes. And I ask them why. Well, if one breaks, there's still 4 other ones holding it. Well, let me tell you something, folks. Most people are operating their financial future with 1 rope. And it might be that just their savings account, might be just their checking account, or might just be their 401k. So if you really want to secure your financial future, you have to have as many ropes as possible holding you up so you can be well established for your future financially. One of those ropes, right? Definitely your emergency fund. Then you want to have life insurance. Then you want to have your retirement accounts. You can have investment accounts. You can have real estate. You can have as many ropes as possible to secure your financial future if done correctly, right? So once you understand that and you diversified your future, the next thing is to understand taxes. How does your money get taxed? This is so important, right? You have 3 different categories. There are accounts that get taxed now. That's like your bank accounts. You have a brokerage account, crypto, take it out, you get taxed that year on any gains, right? Or income tax. Then you have accounts that you pay taxes later on in the future, like a 401k, a 403b, an IRA. You pay taxes when you take it out, a 457, a TDA, your pension, right? You take it out later on in the future. But guess what? You don't know what tax rates are going to be later on in the future. Right now, the way this country is going, inevitably, the way government solves financial problems is by raising taxes. So you might be paying more taxes later on in the future, right? Another thing that you need to prepare for is that 403bs and 401ks and IRAs also have what they call a required minimum distribution. Let's say you don't need your money. Let's say you don't need to touch your money. Well, by the age of 70, it's 73 right now. By the age of 73, if you need to take out you need to, by law, take out a required minimum distribution. And if you don't take out that distribution, the IRS will tax you 25% on what you were supposed to take out. So if you don't need your money, you are forced to take it out. Why? Because the government's not going to let you hold that money without paying your fair share. Fair share. Then you have accounts that you never pay taxes, like Roth IRA and cash value life insurances and executive bonus plans for business owners. And here you never have to worry about paying taxes when you get a distribution. You have tax-free access to your money. You don't have to worry about that required minimum distribution. Now, once again, I'm not saying that any of these are better than the other, but you need to have a tax strategy in place. Why? Because in most situations, people don't have it. And then they make a tax mistake. I'll give you an example. I had a gentleman come to my office and he wanted me to help him after he made a mistake. He retired. He was 70 years old and he took out $250,000 from his 401k. Guess what he ended up doing? He ended up putting himself in a higher tax bracket and had to end up paying 32% 32% in taxes, close to 60,000 plus in taxes because he didn't strategically take out his money. So this is very important. You have to understand this. You know, one of the things that I've learned is there are three types of people. The first person just has financial accounts. They have financial accounts, they open them up, no purpose. They just open them up because they thought they had to and they put money in there. The second type of person has financial accounts and they have a financial strategy. They have a plan in place. And then the third person has financial accounts, they have a financial strategy, and they also have a tax strategy to be able to preserve their wealth. Right? So once you got that, the next thing is we talked about is having an adequate estate plan. And before everything, you know, the first thing I want to talk about is your beneficiaries. Most people sometimes open up their accounts and they either don't fill out the form, don't update their put a beneficiary. Number two, they might put a person's name, but they don't change it later on in the future. And it doesn't matter what's in your will because retirement accounts and life insurance follow whatever name you put in the beneficiary form. I've seen wives not get anything because their husband didn't change their previous ex-wife's name from their beneficiary forms. Also, if you have kids, if your kids are under the age of 18, here in the state of New York, if they're going to receive more than $50,000, then they got to go to probate court. And that process takes about a year or 2 years right now with the way probate court is working. But then the judge gets to decide who's going to be authorized to use those funds. So you want to make sure that you have somebody that you trust if you want to leave money for your kids for that. Then you have your will. Your will is just a document that leaves your instructions on how you want things to go when you pass away. A trust is a document, it's an entity that you form that can own your assets or you can transfer assets to. And actually, I'll go back a little bit before that. Wills can be contested in probate. Doesn't matter how you say what you say in your wills. They could be contested in probate. And number two, they still have your assets still have to go through probate. When you have a trust in place, your assets don't go through probate. They are led through the instructions that you left in your trust, and you can transfer those assets to the trust, and your executor will distribute the assets based on your instructions. Then you have healthcare proxies and financial powers of attorney. These are important documents. Healthcare proxies allow you to choose someone who can make your decisions on your behalf in case you're unable to speak or make decisions on your own. So once again, that's somebody that you want to choose to be able to express things that you may want. And then the financial powers of attorney is somebody that can speak on your behalf and make choices and make decisions with that document. And I'll tell you why that's so important. Look, when my father was in the hospital, he was in a ventilator. You know, they started telling us, hey, it doesn't look good. It doesn't look like he's gonna make it. So I had to call the HR department. I had to call all his different accounts. And during that time, I needed to set up everything so everything can transfer smoothly to my mother. So when I was speaking to everybody, people were like, hey, we can't talk to you. You're not authorized on the account. The moment I told them I have a financial power of attorney, they opened up all the doors. All I had to do was fax it. And guess what? I was able to update my father's beneficiary so my mother could get the money, organize everything so it could be a smooth transition for my mother. So you want to make sure that you have all of those things in place. You want to ensure your legacy reaches your intended heirs, and it's by making sure you have your proper estate plan. But if you want to start first, right, the first place to start is to update your beneficiaries. If you haven't looked at it in years, if you haven't looked at it, you don't even remember who's there, and maybe you need to change some names, then take 5 minutes. Take 5 minutes to update your beneficiaries and make sure that your money goes to who you exactly want it to go to. All right. So we went over all these 6 areas, and that's what you got to build a plan. You have to build a plan around these 6 areas: your cash flow, your debt management, your emergency fund, protection, build wealth, legacy planning, right? And build it on your goals and your budget, not guesswork. Don't wing this. Don't wing your financial future, right? Because if you ever winged anything, it doesn't go as planned, right? Like one time when I had my son first crib, I was trying to be like a man about it. I got this. I'm gonna construct this crib myself. I could do this. I didn't really look at the instruction manual. And by the time I was done, I realized I was missing like a couple of screws, and I had to kind of like undo everything again and redo it over again. Now, the blessing I had is that I had the opportunity to do it over again. But when it comes to your retirement and your financial future, you don't get another shot. You can't get to 65 and come back and say, man, and go to 65 and say I messed up and I need to redo this again, right? You have to be able to do it right now and be able to start. Now, one of the things that we're providing here to all the attendees is that we provide a free service to be able to help you with this financial plan. We work with over 50 companies in the financial industry, and we sit down with you and we create an actionable game plan. We don't charge you anything. We help you with those 6 areas. We create a plan, we give you some recommendations, and then we help you implement those recommendations. And we don't charge this as a service to help you get educated financially and help you implement a plan for you to be able to secure your financial future, right? So the next steps, right? And this is my show. I see some questions actually. But the next steps is here to complete a short survey that we have. I know Palante probably has a survey. I have a survey as well. You can complete this survey. You can scan it. I'll put the link in the chat in a few. But it takes 2 minutes to let us know what you want to learn more about, and maybe we can coordinate with Palante to come back and do some more specific topic workshops. Because I know we kind of like worked 6 areas and kind of gave you the surface. But if you let us know what you're really interested in, we can come in and do a workshop just on budgeting, workshop just on debt, or workshop just on life insurance, and we do workshops on those things. But definitely want to scan this QR code, fill out the form, and if you want my contact information, here you have it. And I'm gonna look at these questions that we have here.
I'm gonna so wait, here, wait, before you do that, um,
Yep.
you finished for your presentation, right?
Yes,
Yeah.
correct.
Okay. So thank you, Ariel. So we're gonna now jump into the Q&A. The first question that we have is, what about student loan debt? I'm unable to pay at this time. What suggestions do you have for a person with over 50,000 in student loans? What is the best way to get them removed?
Great. So there's a couple of I'm not one. I would have to sit down with you specifically to pretty much talk about this. But first, there's a couple of repayment options, and you want to really find out which one works best for you. I know some programs like the income-based repayment option, they base it off of your income, whether you have dependents, and you can lower your payments. And I worked with a client that was paying $1,200 a month on their student loan. We were able to help them lower that from 1,200 to 200, right? So you might want to look at what the income repayment options are. Number two, where do you work, right? If you're working for like a nonprofit organization or a public organization, there are programs like the Public Loan Forgiveness Program, but you have to be working there for 10 years and make 120 qualified payments. And that's a misconception that some people have. They say, I've been working there for 10 years, but I've had my student loan in forbearance waiting the 10 years. No, you have to make 120 qualified payments in order to get that forgiven. There might be some other options depending if you work in the hospital as a nurse. There's some programs out there that help pay off your student loan. So that it's a broad question, and I hope that I could I hope that I was able to answer it. But you could fill out the survey. I'll put the survey back up on the screen,
Okay.
and
And this
you
survey,
can scan it in.
do you have the link for this survey so we could just put it in the chat
Yes,
now? Okay.
yes.
Okay. And for the person who just asked, how can we get this recording session? I will send this recording to the attendees once I have time to, probably next week. So if you guys want, you can rewatch it.
Jakar,
Hmm.
I put the I put it in the chat, but I only think the panelists could see it. I don't
Okay,
know
so
if they
I'll
can.
yeah, I'll do it right now to everyone. Okay, so I just posted that link to everyone. So can you explain again what the survey is, what it entails one more time?
So the survey just lets us know where you are financially. What first of all, some feedback on what you thought of today's presentation. Number two, if there's any area that you are looking to learn more about or you feel you need assistance with. And then if you want us to, if you want to set up an appointment with us, you can set it up through the survey. Or if you want us to reach out, you can just give us permission to reach out to you. And once again, our services are free, but that's just to let us know what areas you want to learn more about. And then we can have a conversation with Palante to come and do some other workshops.
Okay, thank you. And the next question, what credit card company has the lowest interest rates that you recommend?
That is a great question. I don't recommend companies. I recommend to increase your credit score. So a lot of times your interest rates are tied to your credit score and your credit history. So if you show that you have a great payment history and you have a low credit utilization or zero credit utilization, then you can start building trust where people can lower their creditors can lower your interest rate. Another thing is that if you've been with a company for a really long time, you can actually call them and request for them to lower your interest rate. If you've been if you have great payment history, you have a great relationship with that company, you can actually call and ask to lower your interest rate, or if you could apply for that as well. Um, One other misconception is a lot of people hear that, oh, in order for you to have a great credit score, you need to have at least use 30 to 20% of your credit. That's a lie. Right? The banks taught that so they could always be charging you interest. When it comes to creditors, if you pay off what you owe quickly, that shows that you are a great creditor, an excellent credit person that they can trust and have a great relationship with. So the quicker you pay it off, the better, right? Now there's strategies to be able to do that, but one of the things is in order for you to get a lower interest rate, that has a lot to do with your credit score. Somebody that has like a 600 or 500 credit score is never going to have the luxury of the interest rates of somebody that has a 750 or 800. So it all has to do with your credit score.
Okay. Um, this Carisha says, can you please put up your information up again? Okay. The next question, how do I remove a wrong delinquency on credit report?
So one, you can dispute it with the credit bureaus. So you can actually fill out uh, disputes directly sign up with Experian, with TransUnion, with Equifax, and file disputes and dispute those delinquencies. Or if you still owe money or you are working with that company, sometimes they do what they call a pay to delete agreement, where you agree with them to pay whatever balance and they'll delete it from your credit report. There's many other ways to be able to do it. We might need to come back and do that workshop, Jakari.
Oh yeah, that sounds like a good one. Um, what do you recommend to someone with two pensions who is close to retirement with small savings but zero debt?
That's a great question. That's a question I would love to answer on a one-to-one basis. I think you shared the link, right? If you could fill out the link. And the reason why is because something that I might recommend to you might not be something that I'll recommend to everybody else. because everything is based off of your goals, your dreams, and what you're really trying to accomplish. And then you have two pensions. I don't know what your two pensions, what that income is. I don't know what your expenses are, and I don't know what you're trying to accomplish. You see, I, as a financial professional, as an advisor, I operate kind of like a doctor, right? You go to the doctor's office, you say, I have a headache. Can you give me prescription? The doctor's going to say, wait a second. Let's run some tests. Let's run some labs. Let's see what's really going on. Then after the results come in, they give you your prescription. Well, I do the same thing. I sit down with you, understand what you want to accomplish, what your goals are, and I analyze your current financial situation and what you expect to do in the future, what you want to accomplish in the future. Do an analysis, and then I come back with your financial prescription and be able to help you. So, Porfirio, it would be great to speak to you on a one-to-one basis. So if you filled out the form, that'd be great.
Okay, thank you. And I think, well, a lot of people are, asking for the presentation as well. Do you think you'll be able to, we could send this presentation to the attendees who was in it tonight?
Yeah, we could do that.
Okay. But as far as that, I don't see any more questions right now. So Ariel, do you have any like final statements or words you want to give before we close out?
Yeah, I want to, I want to say that, kind of reiterate back what I was saying in the beginning. They say money's not everything, but it really is when it matters most to you. I always talk about how, hey, the roof over your head, where you sleep, it took money to make that happen, right? In order for you to work and pay your bills, it takes money to make that happen, right? To give the quality of life to your kids, to your wife, to your husband, to your partner, it takes money for that to happen, right? But you want to be able to secure your money and be able to do it right now. I want to challenge everybody here to take one small action. Like, sometimes we overcomplicate this. Sometimes we think building wealth is complicated. And it's just taking one small action that'll start developing the habit for you to set yourself up financially in the future. And I want you to think about this as well. A lot of people think about financial independence and financial freedom. And when you think about those words, you think about, man, I need to be a millionaire to have that. But when I've sat down with hundreds, and I've sat down with thousands and thousands of people. And a lot of times when we talk about financial freedom, really what people want is a peace of mind. They want to be able to wake up in the morning and know that their bills are going to be paid, they're going to have food to eat, and they'll have a little money left over for a good time. So just know that your journey is your journey. And what you want to accomplish through life with your finances, or through the finances, that financial foundation that you want to build, is okay. Don't compare your journey to someone else's journey, because what really matters to you is what matters to you, not to anyone else. And that being said, I always say, if you change your finances, you change your world. And with that being said, I leave it to you.
Okay.